This video is about the taxation of Bitcoin and cryptocurrency more generally. With cryptocurrencies increasing in value in the later half of 2021, the question of how they're taxed is raised again. So that's what I want to look at in this video. I do regular videos on tax and accounting issues, so if you'd like to be kept up to date, then please subscribe to the channel, and if you press the like button, it really helps me in the channel. So before I get into the taxation of cryptocurrency, I just want to do like an elaborate health warning. You do need to be careful when you're dealing with cryptocurrency. So first of all, I think, what is cryptocurrency? Because it is different to government issued money. So government issued money is just electronic money, just like cryptocurrency. So in that sense, it is just the same. The main difference is that with government money, there is no tax implication of disposing of it unless you dispose of another country's currency, and then there'll be an exchange difference. But inherently, when you buy something with your currency in the country of issuance, that doesn't affect the tax on the currency that you're paying something with. And you have to use government money to pay your taxes, and the dollar is almost always used to buy oil. So they have those uses. But of course, government money is not backed by gold and is increased in quantum to a huge extent over the last few years, whereas particularly Bitcoin has a fixed monetary policy, so that's another big difference. But before you sort of pile in, just be really careful. There are charlatans out there trying to sell you stuff that's or trying to make you do transactions, so just be really careful. And if you're a newcomer to it, just make sure that you just risk a small amount. So, just play with a few £100 that you can afford to lose, and if you lose it, it doesn't matter, rather than going all in on it to start with. And by doing a small amount of trading, you'll actually learn an awful lot about it. Having said that, it is actually a huge market. So it is a sort of a multi-trillion dollar market. So it is a major asset class, so it's something that I feel that we shouldn't ignore. And I think another health warning is that there are a lot of exchanges. So the exchanges, it's like having your cryptocurrency at a bank. The bank takes ownership of your money if it's at a bank, and a crypto exchange takes ownership of your coins, and then you are relying on them being a good credit risk. Or you can also hold the keys, so you actually hold it, but then if you forget or lose the keys or something, then you lose all your crypto. So there's a risk of somebody else's custodianship against the risk of your own incompetence, and you only can decide which of those two is most important for you, and maybe you want to balance it out between the two. It can be quite hard to keep track if you're doing a lot of trading of the transactions that you're doing. So if you do, there are apps out there where you can which will help you keep track of all the crypto you've got and the tax effect of the transactions that you've done. So if you are sort of having trouble sort of understanding where you are, that is probably the place to go. But let's get back to the tax. Because unless you're in El Salvador at the beginning of September, from the beginning of September, then crypto is not legal tender. So when you dispose of it, it is a tax transaction. And I just want to go through some of the more significant tax traps. But before I go to tax traps, let's just think about the tax tips. So you get an allowance. So when you dispose of a cryptocurrency, it's almost always treated as a capital gains tax event. If you really do an awful lot of trading, it's possible to treat it as a trade. Generally, from a tax point of view, you want it to be a capital gains tax transaction, and also the sort of default position with the revenue is that it's a capital gains tax transaction. So let's just assume it is. You get a separate allowance for capital gains as well as your allowance for income tax. So you can make £1,200,000 worth of gains, you and your partner separately, before they're taxed. So make use of that, because that'll just help. Within capital gains, I think it's just worth remembering what the tax rates are. So as a basic rate taxpayer, it's 10%, and if you're making significant gains, then the top rate for investments is 20%. So that's lower than property, but it's 20%. So if you made £1 million of gain on your crypto, happy days, the tax rate on that will mostly be at 20%. So actually, it's a lot lower tax than you might imagine. And if you look at videos on YouTube and stuff, a lot of them are referencing the US tax rates, which I think are actually higher for capital gains tax, although I am no expert on US tax, that is for sure. So 20% is the main tax rate, so that is quite a good rate. So what are the traps? So the most fundamental trap is that when you transfer between different coins, then that is a transaction for tax. So if you sell Bitcoin to buy ETH, then that is a tax transaction. So if you've got an account with lots of different crypto in it and you're buying and selling them, each time you transfer between the different coins, that is a tax transaction. And therefore you need to note down that and see if you got a gain or a loss. So that, I think, is the biggest, most significant trap, and that's why I'm talking about it as number one trap. The second thing is the way that it's matched. So for capital gains tax, normally people buy stuff over a period of time. What happens is that creates a pool. So so if you've got like 3 Bitcoin, happy days, great, and you bought it in 10 different installments, the whole cost, and you spent £40,000 on it over the whole period that you bought it, that cost is pooled, and you take an average cost per coin or per sat, so that you match the transactions when you sell it against the pool. There are, of course, some exceptions to that. So the exceptions being, if you buy and sell something in the same day, those transactions are matched, and if you sell something, then that's matched with anything you buy in the same thing over the next month. But this can cause a sort of problem, because if you buy £50,000 worth or spend £50,000 on crypto, and then it becomes worth £100,000, but you sell half of it, sell £50,000, at one level you've got no cash profit because you bought it for £50,000, you've sold half of it for £50,000, there's no cash profit, but there is a tax profit because you match the £50,000 of sale proceeds against half the purchase price, so £25,000 of gain, and that becomes a taxable transaction. So it's worth bearing in mind that the cash doesn't always follow in the way that you think because of the pooling of assets. That's why you need to be really careful to keep a track of your transactions. The next tax trap I want to talk about is saving your tax money. And really you need to save your tax money in the means of payment, i.e. in sterling, because if you save your tax money in crypto and it happens that at the moment you need to make the tax payment, it's very low in value, you might not be able to make the payments, or you might have to be a forced seller into a bear market, and you might not want to do that. So the timing is quite important, that for personal tax, you're always to a 5th of April tax year for capital gains. So if you bought and sold and you made a profit in the year to the 5th of April, but you still got that you've still got that profit in in Bitcoin or another crypto asset, then you've just got to be really careful, because that tax will be payable in January of the following year, ages after you made the transaction, so it's easy to forget, and the tax will be payable in sterling come what may. So just please bear that in mind. There was a sort of a small fear, uncertainty, of doubt. There was a thing about cryptos being the tax avoiders and drug dealers' best friend. I think that is nonsense, because you can see all the transactions on the ledger. So why would crime be particularly attracted to something where there's so much transparency? However, there is a bit of that going on. So it's easy to believe that the revenue can't find out about your transactions. Well, you should always pay your taxes correctly anyway, but the exchanges do report as well, or they may report in the future. So even if you think you can get away with it, it's just not worth. It's not worth not owning up to your exchanges. And in any case, if you want to spend it on something impressive, then you need to have gone through your tax return. But it's something that you should do anyway, because it's the right thing to do. Some of the exchanges on some of the coins are now giving you income. So if you hold a coin at one of the exchanges, then it gives you an income, because in the background they will leverage that to the traders and the dealers. So if you do that and you get interest, don't forget that interest will be taxable, and that will be income tax rather than capital gains tax, and it should go onto your tax return. So another question that I'm sometimes asked is, should it be in a limited company? So should you have your crypto in a limited company? Well, I think you will find that it's more difficult to get it into the limited company. But notwithstanding that, capital gains in this sense are normally better off personally, because, as I say, you have the 20% tax if you make a profit and hold it personally. If it's within a limited company, now there might be an advantage in that the money is already in the limited company. You have to go over a tax hurdle in order to get the money out. You might not want to do that. But if it is already in a limited, if you do put it in a limited company, the problem that you can have is that the company will pay tax on it, corporation tax, and then it and then in order to get out of the company, you have to pay personal tax. So effectively they get 2 bites out of you, and you will pay more taxes, because you'll be paying more than 20% tax if that is the case. So when you're thinking about whether to have it in a limited company or holding it personally, you're probably better off holding the coins personally. So there we are. There are, hopefully, if you're investing in cryptocurrencies, you're enjoying the increases that we've had over the last few weeks. If you're new to it, take great care, and just be aware that the tax man is aware of all the profits, and is looking to make some money out of people bringing their crypto into cash to pay off the mortgage or buy a car or something. So just be aware that you do need to be careful to record your transactions, and then careful to put them on your tax return, and just be aware of the tax rates and how much tax, so you've got the money saved. Thank you for watching and listening. If you'd like to subscribe to the channel, you'd be very welcome to join us in future videos. If you press the like button, it helps me and and if you press the like button, it helps me and the channel. Thank you.